Well, thank you, Dave. Good morning, everybody. Thrilled to be with you and hope you're enjoying these markets. We certainly have had our share of volatility and an opportunity, I would say. And, that's the thing. I think volatility creates opportunity if you know what to look for. Like Dave said, hey, there's always risk in trading. We've got to have a plan about how we're going to manage the risk as well as the reward. So I'm going to walk you through three of my favorite kind of big cap tech names, and we call it our AAA options bundle here with Apple, Amazon, and Alphabet, of course, is the parent company name of Google. GOOGL is the symbol we like to trade for Google, using just a couple indicators, using the ADX, the average directional movement, and the DMI directional movement line. So these are like really clean, simple trend reading indicators for popping in typically early in the day and being out before the end of the day. So this is definitely more of a quick trading. It's not something that's scalping in a matter of minutes. We still expect to ride trends over the course of a day when we catch these moves. And we're going to walk you through how it works. And we're going to talk about the risk too. So as we get into it, let's just remind you that, hey, everything that we share with you in today's presentation is based on our proprietary research. It's intended for illustrative purposes only, should not be considered specific advisory recommendations. As you know, stock and options trading have both large potential rewards, but let's face it, they've also got large potential risk, right? Leverage is a double-edged sword. We're going to show you how we manage that and when we cut and run versus when we hold. Remember, the past performance of any trading system or method is not necessarily indicative of future results. Future results will vary. What you cannot allow to vary is your commitment to following whatever system you're looking at, right? You've got to be just really committed to that. And I think when you commit to that, it makes you a better trader because you just say, hey, I know I'm going to have wins, I'm going to have losses, but it's about following my rules, letting the system do the heavy lifting as we look forward into whatever may happen next for the markets here. So let's get into it. Let's talk about how we like to trade options on three of these monster tech names, the mega cap tech, magnificent seven type of names here. And I've been trading options for 37 years and frankly love options for what it can do for any view I might have, up, down, or sideways, right? So that's really what we're after here, is being able to take advantage of that, leverage it intelligently, not be overcommitted to any one trade though. That's a big part of it too, right? Be that steady, consistent executor. You'll find it'll serve you a lot better. Walk you through when it works. We'll walk you through examples when it doesn't work. And then we call it AAA options because it's those big three that all start with the letter A. So let's a quick overview on me. Remind you that, hey, I've been trading 37 years. That doesn't guarantee anything, right? No matter how much experience you have. I know my team and I, we all know we have to follow our system. Once we've done the research about this is the system that's going to guide us, the technical system, once you follow a system, frankly, it makes my life and your life a lot easier. You don't have that constant questioning going on in your head of going, do I get in? Do I get out? Do I hold? Do I bail? It's just you follow the system. When the system says get in, you get in. When the system says get out, you get out. Your life's automatically simpler in my experience from that. Let's go back and look at a recent winning trade we had on tax day, April 15th. It was a good one for us. It's not a day I know a lot of people look forward to, but let's face it, hey, it worked out really well to help pay some of those tax bills and more. Bottom line is that this is an Apple trade that we called out. Now, what are we looking at here? We are looking at a 15-minute candles. Okay, so we're talking pretty short term, 15 minutes at a time updates. Why do we like that? Because it gives us enough adjustment, but not being too hyperactive to what's going on minute by minute, right? You want to still have some type of an action point that makes it more clear for you about exactly when should you get in, when should you get out, and still not be so reactive to just price action alone. That's been my experience, is that we're not so reactive to just price action alone. It makes our job just about following the indicator setups and following what I call the structure of the markets, right? The structure of the markets is what you want to get working for you so that you can say, okay, if the structure's good, I want to be on it. If the structure's broken, I don't want any part of it, right? That's the nature of trend trading success, is that you're really looking for those bigger trends. That's the name of my company, BigTrends.com, because it's really all about find those opportunities to catch it and ride. If it's not there, you get out, you move on, or you just stay away. So this trade, what are we looking at? I think this is even more instructive on the price action alone doesn't drive the trend, because the start of the day on that Wednesday morning, April 15th, is actually this first attempted rally here. You see on that high wick that ends up coming back down. And by the end of that first 15 minutes at 9:45 Eastern time, look what's happened. We have technically failed on a price breakout if you're just reacting to price action. Those who are trying to chase that breakout, then getting whipsawed, stopped out when it comes back down. Oftentimes have that once bitten, twice shy mentality where like, okay, burn me once, I'm not going back in. That's oftentimes exactly what you have to be willing to do if you're a pure price action trader, is not get overreactive. I would rather try to miss those fake outs and get on the true breakout. So what are we looking at on our bottom indicator is going to tell us when the structure was actually the right time to get in based on our system, not being premature, not being early, not trying to be cute in chasing a breakout that wasn't confirmed. And the thing we're looking at here is that this blue line is what's called the ADX. Now, I didn't develop it. Wells Wilder did, one of the famous technicians of all out there. He developed a lot of indicators like the RSI, Relative Strength Index, and more. But ADX means average directional movement. You want to see that average directional movement, blue line, trending up. We like it off a relatively low level. We don't define it just on an absolute level. We actually look at our directional movement lines. The positive directional movement line is in green. You see that's going up. What is that telling you? It's telling you that you're getting higher highs on a recent look back period. The negative directional movement line in red here says how many new lows you're getting. Not many, right? We've been kind of hovering at or above those recent lows. So we're getting less new lows. So what I really like to see is where the ADX starts trending up and crossing above that declining directional movement line. In this case, the negative directional movement's going down and the positive directional movement's going up. You know what that implies? Higher highs and higher lows implies an uptrend is building. But rather than having to guess that, draw channels, kind of wonder if you drew your channel right or not. I've been there. I've done that. I've done a lot of it in 37 years of stock and options trading, right? Rather than trying to play that game, what we're really looking for instead is let's just make sure that ADX is crossed up, and then we go ahead and ride it until it crosses back down. So what do? When it crosses up there, as of 10 o'clock, we're hopping in right at the start of this next new 15-minute bar, literally just a couple minutes after 10 a.m. Eastern. So we've got a half hour into the belt. It doesn't look like much has happened, right, in those first two 15-minute windows to make that first half hour's range up. And yet what's happened underlying the surface is that we're getting some improvement in the higher highs and the higher lows, and the ADX picks up that we're getting that crossover. So it says that now there's opportunity for the trend to really be your friend to the upside. And we know it's an upside ADX signal rather than a downside one because of our directional movement line position. The bulls are winning the war with higher highs and higher lows. If it's flipped around, we'll show you if we have a bear example, it's a little bit different the way we handle bear trades, but we'll show that to you as well. So we buy calls at that point. We call it to subscribers for our AAA option service. Hey, right there, we want to get into calls on Apple. And so we recommend, and look where it's trading, by the way, it's trading about 258.5. So here, what are we buying? This is on a Wednesday morning. Now, if it's a Monday, Tuesday, or Wednesday, we're interested in buying that same Friday expiration. Why? Because we know we'll be out before the end of the trading day on any of those days. So at the latest we would hold this will be Wednesday afternoon around 3:30 p.m. Eastern time, half hour before the cash market close at 4. And so the idea here is that, okay, we know that's our time stop, if you will. If it's a Thursday or Friday, we're going out to the next Friday's expiration. Of course, all these big name stocks have every single Friday weekly options expirations. So we're about 4 points out of the money. You say, man, that's aggressive to be 4 points out of the money. And you say, but look at it as a percentage of the stock value. It's basically just over 1.5% of the stock out of the money, right? So about 1.5% of the money, that's very doable for a lot of these big name stocks to move multiple percent in the same day. It doesn't always happen, of course. We're going to talk about what happens if it doesn't fire too. But our goal is we want to not just double these, we want to triple these options. We've seen a number of times where you can triple them in a day, or in this case, well, less than a day, right? Because these are every 15-minute candles. You can see that literally 5 candles later, which is basically an hour and 15 minutes later, Apple has gone from 258.5 to hit a high at 264. So that's what you learn as you start to trade options, is that some of the best bang for your buck happens when you go from out of the money to somewhat in the money. That pickup in what's called the gamma effect, which means that you're picking up more and more bang for your buck on each next point move in your favor. In this case, we had, you can see, about a 5.5 point move in our favor. Every one of those points moving for us was picking up more and more bang for our buck. The first point move was not as powerful as the 5th point move in terms of what it was doing to our option, right? Because it's going from out of the money to in the money. So that $107 a contract we had to pay to buy each contract controlling each 100 shares is getting more and more leverage based on each next point move in our favor. And so that's called, you're picking up delta, more and more bang for your buck on each one. The point is, you don't have to know those option Greeks, but you follow when we tell you to get in, when we tell you to get out. So we paid 107 bucks a piece. In this example, we're assuming, okay, what happens if you buy up to $1,000 worth? That would get you 9 contracts. Remember, each of those contracts controls over 25 grand of Apple stock on 100 shares, right? So you buy 9 contracts here, you're pushing towards, a pretty massive $250-ish thousand that you're controlling of Apple stock for less than $1,000. You can see the implied leverage of that is dramatic. So that's why you don't need a huge move in the stock to get a huge move in the options, right? A 5-point move in the stock, we don't get all 5 of those points, right? Our $107 a contract that was all-time value has now gone in the money, is now worth $322 up there as we cross up and push towards that 264 level. At that point, we've called Apple correctly for a couple percent to the upside. Our couple percent move in Apple to the upside has turned into 200% in our options, and thus we're seeing effectively about 100 to 1 leverage on that particular example. It's not always going to be that dramatic. Some moves are faster, some moves are slower, right? But the idea here is that you want to give it a chance to run. That's why we're not taking partial profit earlier. We've seen that these can happen very, very quickly. Notice, why were we so comfortable riding that? Not just because the stock is going up bar after bar. You can see our blue ADX line continues to rise, which makes sense, right? Because you're getting more and more new highs, less and less new lows. The uptrend is getting even more dramatic in that case of basically having no give backs. So we'll show you some examples where they're not quite that smooth and they still can work out very nicely. So the ones that don't work out as nicely, we go ahead and stop them out if they hit a 50% loss, or if we hit our time stop, if we haven't gotten our target profit or our stop loss by 3:30, we get out at 3:30 no matter what that same day. So you're never left kind of holding and hoping. That trade, of course, on just under $1,000 invested, 963 bucks invested before commissions. Remember, you shouldn't pay more than $1 in per contract and $1 out per contract at most. I know if you're getting more active, you can actually get your costs down even more, well below that. You see, at max, our commission would be like $18 at most, $9 in, $9 out in this example. But you see, $1,900+ in profit even after that. So again, there's times where we trade Apple and it works, times we trade Apple and it doesn't. You're playing the probabilities of a systematic approach, letting the size of the win really help carry you compared to the typical average size of loss, which we've kept at 50% or a number of times less. So you look at this and say, okay, so we're using a 200% or triple profit target, but we're going to use that 3:30 p.m. time stop to be out by the end of the day. Or if that ADX rolls over, the indicator-based exit, when we'll look at some examples where it rolls over, that will also get us out even before 3:30 or before we get too much of a give back in our trend, reversing the other direction. So our holding period, of course, is just for the day, right? And we think this is important because, of course, one of the big news events that just happened here earlier this month is that the SEC has abolished the pattern day trader rule. That was put in place at the start of the 2000s, after the 90s top and the boom in tech stocks and tech stock options. It was put in place to basically say you got to have 25,000 plus in your trading account. You don't anymore. That's basically been abolished, and so now it's just a question of how long it takes different brokers to implement that. You can just follow the broker rules as far as how much cash you have to hold, which will be a lot less than those prior rules. So this is, I think, going to make for a boom in day trading options in addition to stocks, but particularly day trading options, I think will be a benefit for a lot of smaller account traders who are looking to cut their teeth, test out strategies on a smaller amount of capital, and get comfortable at a smaller starting base. So this is, I think, something that's going to be a big trend to come throughout this year and into the future years. A lot more options action. So you can see here that our ADX pattern with the DMI setup on the 15-minute chart is our structure here. We're only going to buy a call or buy a put with this strategy. We're not going to do any spreads. We're not going to do anything complex. We're going to keep it really, really simple here. Okay, so the KISS principle has served me really well in 3.5 decades of trading. So that's what we want to kind of remind you of, is that you should stay really simple to get the most out of your best trend trades, and to just have a plan for the ones that don't fire, right? That's a big part of it too, knowing when to clean them up. Now, we can't get into these trades on a bullish trade if it's after 10:30 a.m. Eastern, right? We want to see them follow through very quickly. Could follow through at 9:45, 10 o'clock, 10:15. But then after 10:30, we start looking for potential bear trades for buying a put. A short would be a put purchase for betting on the downside. And that's a little different pattern. I'll show you that later. Still using ADX in a different way. So this allows our focus to be like bullish early on, and then bearish if it's basically reversing after that attempted breakout and looking like it's going the other way. So it kind of gives us kind of that bullish first hour, bearish next several hours potentially as far as what we're looking for. So we're going to always be monitoring the 15-minute time frame. But the beauty is you're just using 3 big name symbols: the AAA, Apple, Amazon, Alphabet, parent company of Google. So the idea here is that you're not trying to track a whole universe of hundreds of stocks. That can be very, not just time consuming if you're trying to track too many names, but frankly, if you try to do too many things at once, what do you probably end up doing? A whole lot of nothing, or you have a whole lot of confusion in what you're trying to do, or a whole lot of overwhelm if you're trying to be in too many names at once. We'd rather be tight, freshly focused, and keep on looking for those big 3 that, of course, have very liquid, easy to get in, easy to get out options. So how do you get this bang for your buck? We're, like I said, trading the same week expiration earlier in the week, unless it's a Thursday or Friday, then we'll trade the next Friday's expiration. Most every example you're going to see here, because all 3 of these names are out there trading well over $100 a share, is we're typically going to be trading out of the money options. Near the money would be ideal if we were willing to pay a little bit more, but we're not. We want to get that extra bang for our buck of fairly cheap options, and those cheap options are the ones that can triple a lot easier when you catch them in these trend phases. You look at overall performance going back to the early 2024 window here. So we've got about, you can see 3 1/3 years under our belt here. I'm sorry, yeah, so take it back, 2 1/3 years, 24 and 25, and thus far in 26, 2 1/3 years. So you're basically talking about the last 27 months, generating over 34 grand of profit, starting on a $10,000 model portfolio if you're applying $2,000 a trade. So you can do it with less, you can do it with more. But the idea is that, and remember, we're looking backwards, so past performance can never guarantee future results, right? You know, the future will vary, but what you cannot allow to vary is your game plan on how you're going to consistently apply capital. So we're not trying to compound this, right? Even when we start at 10,000 and grow it to 44,500, we're saying we're still using $2,000 a trade. So obviously, as you grow your portfolio using a fixed dollar per each new trade, you're going to actually lower your dollars at risk as your portfolio grows. The goal of this is to not try to compound yourself up, and then if you keep compounding after gains, you're going to guarantee that you're going to keep on putting more and more in and be hit even harder when you do get a drawdown. That's not what you want. So I found this to be a lot more stable capital allocation model to keep you in the game for the longer haul. And so that's what we're after for our BigTrends community and fellow traders. So again, this setup is that the ADX is crossing off a relatively low level. That's different than some of the other ADX teachers out there that might teach you that we want ADX to be high because that means we're getting a high amount of trend. My experience is when you wait too long, you miss too much of the move, right? We don't want to be missing too much of it. We want to know there's plenty of meat on the bone even after we get a move started. So that's what we're after, is that sort of initial breakout catalyst of the ADX cross that we think has a lot more to go. So these are designed to be quick trend trades. So, and by the way, when you learn this method as a subscriber, which I'm always teaching my subscribers in addition to giving trades, we do a lot of education. You can apply this to any other time frame down the road. I use it across daily charts and even longer term charts for some of my longer term retirement account trades and investments. So the idea is that you can apply this across a lot of time frames. So the idea here is that we're not going to carry anything overnight. Therefore, you don't have to worry when you go to bed about what's going to happen tomorrow in Iran, what's going to happen coming out of Washington, D.C., what's the latest tweet or post out there that's going to potentially shake up the markets on the next morning's open. We don't want to have to sweat that. So this is why we're really about keeping it simple, really allowing you to focus on how you can get a lot of bang for your buck here. The short signals would be just different parameters. We'll get into that. Now, let's look at another example. So here's a Alphabet, Google, GOOGL is a symbol trade. And you see it's a gap. You want gaps with this methodology in my experience. And the last one we showed you wasn't really a gap on Apple, but you know what gaps tell you? There's some catalyst, there's some news out there. You know, yesterday morning, of course, there was news about OpenAI wasn't hitting its targets, and so a lot of the tech complex got popped down initially. So that doesn't necessarily mean we're going to trade puts on a gap down, but it means that we're looking for that potential setup. So you see, we had that set up and it confirmed at the first 15-minute bars close, even though that was a red candle, meaning we opened up here and then we closed a little bit lower. It's saying, look, we're getting our upside cross in a bullish way with the higher high and the higher low. Remember, part of the reason that ADX keeps going up is even if this was flattening out and we're stabilizing through here and going up here, but even if it was flattening out, you're losing older data looking backwards at the prior session here that was at lower highs and lower lows, right? So ADX is adaptive and it's not quite so overreactive to just a price action bar that looks like it's flipping down. I've always said any one bar, any one candle doesn't determine the trend, right? We've got to focus on the bigger, like how they line up after multiple bars, multiple candles in a row to say, okay, what's the trend truly telling us here? So the beauty of this is that, okay, I'm going to just let that play out. I'm waiting for ADX to roll over if it's going to get me out. Otherwise, I'm saying, look, we know that we want to be in a position here where we say, look, let's focus on exactly how we can let this thing keep running. So even when you get through, we get that first move in our favor here, but then you see we go through a little flag pattern, a little sideways action. You think, well, isn't that going to eventually cause the ADX to roll over? You can see that our positive directional movement line is edging down here, or negative directional movement line edging up, but it's not doing it so dramatically. So ADX is still rising, maybe at a little slower rate here, but it's actually saying we're still getting higher highs and higher lows compared to where we were looking backwards. So that by the time Google gets up to our target, put a T on it here, look where we've gone, by the way. Google, parent company Alphabet, of course, started up here about 276.5. We bought about 6 points out of the money, 2.5% out of the money, the 282.5 strike calls. That was a Tuesday morning. So we're buying that same Friday's expiration, knowing we'll be out by Tuesday afternoon. Here we are, where we're getting our profit target, 1,300 hours military time. It's about 1 o'clock Eastern time. Still a few hours to go before that day's close, and the stock has rallied. You can see up to in the neighborhood of about 285-ish, right? So again, what's happened? We've gone on a 282.5 strike from about 5 points out of the money to now a couple points in the money, and said thank you very much. Our $119 a contract, that would have got us 8 contracts in for like 950 some odd dollars here, and you say, okay, well then basically you're getting in there at that, and then you'll see that 952 in makes us $1,904 before commissions on the 8 lot in, 8 lot out at the triple target. So that's the best kind of inflation. You know, we all hate inflation in the economy. We hate inflation at the gas pump or at the grocery store, but I love when my time premium inflation gets an inflation up to triple thereabouts, because you can see we're going from out of the money to at the money is where you have the most time premium. Then we're going a little bit in the money even. So that's a big premium inflation that helps you. Here's another one that looks like a fake out for the price action trader that actually set up beautifully on Amazon for us. This was on a Wednesday morning. You can see that again, and notice when ADX had been going down, the blue line's going down the day before. What's happening the day before? Not much, right? It's like watching paint dry. You get traders who've been watching that saying Amazon's going nowhere, looking backwards. And in fact, you need those periods where Amazon has cooled off, where ADX has actually come down, where it's been non-trending. Those periods then set you up for it to then set up for coming out of non-trending into a trending phase again, right? So that's a big part of this whole approach here, is say, look, we want to see a situation where it's been dead. It's kind of like watching paint dry, and then look what happens. We get our ADX cross. Notice the cross is coming again on what looks like a price action fake out, where it started to break out on that Wednesday morning, and then it even had a red close, a dramatic flip back down, where the classic candle follower would say that's a very bearish, what's called a bearish engulfing pattern, a bearish reversal pattern, where it made a higher high, higher low, and a lower close. Most people would look at that and say that's bearish, right? Well, look at our DMI lines. Our DMI lines are positive, well above negative. So you can see that we actually, the prior day, even in retrospect, just looks like a little retest of where the bears tried to take a shot at Amazon on the downside when the DMI lines cross the other direction. I call that a DMI kiss. We're not really using the test point inflection of the DMIs here. We're really wanting the stronger trend phase where the blue ADX line starts to trend here. I hope this is making some sense to you, because I know I'm covering kind of a lot of the nitty gritty of the indicator, but it's really it's a popular indicator, but I think that's often at least not used as effectively as it could be by a lot of other traders. Remember what I was saying? I've seen some people say, wait till ADX gets to 40 here. You can see by the time ADX gets to 40, that's about noontime. At noontime, you've left at least half of your trend on the table at that block there, right? We don't want to do that. So we're getting in literally as the ADX turns up right at the start of this bar. A lot of people would be thinking that last candle looks bad, and we're saying no, it's actually setting up that it just made that higher high, and that higher low is setting us up for a start of a trend phase to the upside. So look, Amazon trading about 221 or 221 and a quarter. We're buying about 6 points out of the money, almost 3% out of the money, right? 227 and a half calls. We only paid 57 cents or 57 bucks to control each 100 shares of Amazon stock, which would have cost us just over 22 grand worth of stock we control for 57 bucks. Now, of course, when you're buying $1,000 worth, that means you're going to get a lot of contracts, right? You're going to get something like 17 or 18 contracts here. So the idea is that, okay, we get into say 17 or maybe even 16 contracts, but bottom line is that we're getting plenty of contracts, right? I never trade for maximum contracts, but I trade for trying to get my dollars about evenly allocated across each new signal. If I'm putting $1,000 in per trade, I want to get up to and no more than that into each new trade. So from that perspective, you see that, okay, we buy that at 57 bucks. You multiply that times 3 and you see that our target is going to be 171 bucks. Well, look what Amazon does. It goes literally vertical. I mean, in retrospect, almost every one of these candles, you can see there's that one that slightly undercuts the prior bar's low right here, but put a circle around that. But the idea is that that's the only time that it had a lower low than the prior bar. But for the most part, you can see even there, ADX is still rising because, of course, it's making the higher high, higher low versus where it was in a previous look back. So you can see that by the time it gets up to our target, it's still about a buck out of the money here, right? 226 and a half, we've got a 227 and a half call. That is the true example of time premium inflation. You say, well, how's that possible? Because haven't we lost time? But you've lost time, but you've gained more than what you've lost in the form of a more accelerated trend that makes that time premium that's left still even more valuable. So the speed of the trend is overcoming the loss of time in that particular phase. That's what I've always said. There's a battle going on between trend and time regularly, right? And so if you've ever bought an option and lost on it, even when you're right on the stock, it's because you were on too slow of a boat, that the movement in your favor was not moving enough to overcome that loss of time, right? So we want to be on the faster speedboats, not the slow turning aircraft carriers, right? So the idea here is that we want to make sure we're catching that. Here's another example of a gap up. This one's on Apple, right? Again, candle followers alone are saying, well, there's no real follow through off the open here. It's kind of consolidating here. But again, that gap up is saying, look, it's cleared out of all those recent highs. And it's saying like we're making higher highs. Obviously, we're losing the old lower lows compared to where we now are support. And we're saying we want to buy that. And so we're getting in right after 9:45. We send out our real-time alerts. So it might take a minute or two after the 15-minute candle closes by the time we get it out. But that's why I do recommend that you get it with both, not just the email, but also we set up a real-time text alert. So that way you don't miss any new entry or exit instruction. But once you get in, your first objectives are really simple, which is that if we lose half of what we paid, we'll say goodbye to it. Or if we make triple what we paid, we'll go ahead and hang in there. Okay, so for the triple. So if we paid $1, you target $3. We paid 88 cents, we target 264, right? So that's our triple target. Notice here again, after a couple of bumpy 15-minute bars, right? It even had a slight undercutting right there as we headed into the about 10:30 close. We had between 10:15 and 10:30, we slightly undercut. So we were initially down a little bit on this, not a lot, but a little bit of a waiting game there. And you can see that's okay. That's fine. We don't want to get whipsawed by that, right? If the ADX had rolled over, we would have gotten out. Notice the blue ADX line keeps rising. That's why I followed the line more than the price action, because that line of ADX is really my guide. You can see that if we hadn't already gotten our target, right, we got our target at the triple up here at about the midpoint of the trading day, the power lunch about 12:45. We're getting out the midpoint of the trading day just before that 1 o'clock, 1300 hours. But you can see that if you're just following ADX rolling over, there's your ADX rollover finally hitting around 315 as it hits down right here. Now, of course, that would be a worse point to get out on that particular example than where we got out, not just because it's lost a little bit of price action, but you have lost a half day of time as well, right? That was back on September 19th. So the point of this is that, okay, it's about rinsing and repeating and looking for these patterns again and again. But let's talk about some that hit their time stop when they don't get to their 200% triple target. Here's one that rolled over on us. This was Apple. After you see a shot up on a Monday morning, we're getting that breakout, and you see we're hopping in there, and you can see that stock's trading about 257.5. We're buying a 265 call. We get about 5 points in our favor. You say, why didn't you make your target? Well, sometimes it gets there, sometimes it doesn't. And then you can see once ADX rolls over here, the rollover points coming off of that that flip the other direction. We're saying just take the 70% gain and let's move on. You can see not much happened. That's what will happen a lot of times when ADX rolls over. ADX rolling over does not necessarily mean it's got to go the other way, but it often will chop around. But if ADX gets too high, we'll show you an example where it can actually set up for a bearish opportunity. So you see, here's another one with Amazon on a Wednesday morning. We're buying that same Fridays. You can see March week 1 options back here last month, March 4th. We paid 165 bucks a contract. You can see that we were expecting it to get going. You can see that it was just pretty slow there. You know, it starts to move that very next candle, then it settles back down to about where we got in, maybe slightly undercuts where we got in. So not much is happening yet. Then it does work its way higher, but here's a case where, gee, we're hitting down into that the last hour of the trading day, and we're just like, let's just take the 30% gain and move on. So no big home run in that example, but it's just showing you there's a number of times where you just clean it up and move it on. So how many trades can we expect with this method? We expect, because this is why we don't just follow one symbol with this method. We use all 3 of those AAA names, Amazon, Apple, and Alphabet. We've been averaging about 7 new trades a month. You'd think you'd get more with that, but we're pretty picky, right? So it's like that pickiness actually serves you well. So here's another Amazon example. We can see it starts to work, right? We start to get that breakout right after that first 15-minute bars gap ups, right? So when you see even a moderate gap up here, right? It closed at 201, it gaps up by the 15-minute close, it's 202.5. Not a huge move, but that 1.5 in our favor, we're thinking is a pretty good sign for Amazon to keep going, and it's got about 5 points out of the money. We hop in there at 93 cents, 93 bucks a contract. That would get us a 10 lot for 930 bucks on a $1,000 maximum. You see it does pop up here at about 206.5. We were pretty close to our triple target, and then you can see what happens. The ADX rolls over, and we only make about 84% out at $1.72 or $790 profit as of about 2 o'clock Eastern, 2:15 Eastern, right? So the point is like, okay, after that, it kind of went down, went back up, not much happened, but it's just like, okay, if the ADX is no longer at our back, if we don't have the, like you're sailing, right? The wind's at your back, get your sail up and coast on that, right? Coast on that strong ADX. ADX rolls over, batten down the hatches, hop on out. It's time to say that the wind's not in our favor anymore. It's not necessarily against us, but it's just choppy. We don't want to hang around for choppy waters. We want smooth sailing. So the idea here is, here's another one with Apple back October 24th. You can see this one we actually had to go further out of the money because there was earnings coming up. Right, that was on a Friday, so the next Friday expiration we buy, and so that was the Halloween October 31st expiration. I think they had earnings the day before, so we were paying for some time premium there. So we had to go to the 275 strike call when the stock here is about 260, right? So even though we got the move from 260 to 264 by the time the ADX rolls over, that normally would probably be good for more than a 57% gain. We're not complaining. We'll take 57% in a day, 560 bucks of profit on the 10 lot. But the idea is that, 20 bucks commission, 540 net. The idea is that, okay, look, we'll take the money and run and just say, thanks very much. Now we're moving back to the sidelines because ADX is rolling over. But you can see the rinse and repeat approach. So like I said, the pattern day trader rule being repealed, eliminated as of April 14th, that doesn't mean that it's all been implemented across every broker. They gave the brokers some time. They said as much as a 12-month transition period. I think brokers are going to be a lot faster to adapt than 12 months. They've been waiting for this for change for years. But it's now just based on intraday margin calculations rather than a fixed dollar minimum equity. So that's a big breakthrough, I think. And so the bottom line is that should lead to a lot more day trading strategies for option traders, even on small accounts. A few more examples. I know I'm tight on time here, so let me quickly just go through. We already talked about that Apple one. Let's look at some other ones here. Let's look at a losing trade, okay? Here's a Google trade where we look like we're getting the upside breakout, right? You say, well, gee, this thing's broken out so much. Are you chasing too much? We want that first momentum candle there. So we hop in right at the start of this next candle here. So you can see we're hopping in, as it turns out, near a short-term high. It's going to happen sometimes, right? But the nice thing is that you can see the ADX starts rolling over right here before noontime. And so, yeah, while it didn't follow through, we're hopping on out here about 253. We bought it near 256. We're wrong on the stock by about 3 points, just over a 1% move on the stock. And yes, it's a leveraged instrument. We lose almost half. We lose 48.8% in at 144 bucks, out at 78 bucks a contract. It's going to happen. You should prepare for that. That's why I don't want you getting too high or too low. Here's another quick tripler on Amazon. You see that kind of big breakout. That's why I want to see that big move. It was at 203, the prior day's close. Now it's almost 210, right? We're buying a 212.5 strike call right here when the stock's just under 210. 124 bucks means we get 8 contracts, and literally in a matter of just about 3 hours or 2.5 hours, we've gone from 210 up to 215. Went from 2.5 points out of the money on the 212.5 strike call to 2.5 points in the money, and we've gotten about 2.5 bucks on that option. 250 bucks a contract times 8 is about a $2,000 profit, right? So that's what we're after, is that type of objective. You can see if we waited for ADX to roll over, it would have gotten us out later. So we're glad to have that triple target under the belt. We mainly trade calls. Here's the downside setup. The downside setup is different. We get the shot up, but it's too much of a shot up. Look at where ADX is trading at over here on the right panel. ADX is over 50 plus, and then it starts coming down for 2 bars in a row. We found that that's usually a sign that it's going to converge down. We're going to get a consolidation back the other direction. So in this case, we're buying Alphabet 177.5 strike puts. You can see it took a little bit of time, right? That was happening around 11:30. It slowly rolls over, right? Tops take a little more time to form usually. That's why we like to see that we've had that reversal off the high ADX, and then we caught the spike down intra-bar here to 175 from about 179.5. About a 5-point move in our favor gets us the triple on that bearish one. So what we're setting up for is a way you can try it out for the next several months. Okay, so here's how this works. Usually my subscribers would pay like 297 bucks a month. So this would usually cost you in the neighborhood of almost 900 bucks, $891 over 3 months. I'm going to slash it for you because Dave and the festival team have been great to me to help spread the word about big trend strategies like AAA options. We do a lot of teaching as well. When you learn the settings and rules, we just ask that you don't share it with anybody else. When you sign up, you sign a terms of service that says you will not share this valuable information with anybody else. Okay, so bottom line is that you're going to get these real-time alerts for the next 90 days. I'm going to slash it down from 891 to just 177 bucks. I figured, hey, that's about $2 a day, just under $2 a day. Should be well worth your investment. Having a little skin in the game, you keep the vast majority of your money working for you, but you get to learn the strategy for the next 3 months for just 177 bucks. After your 90 days is up, you'll get our best renewal rates as an existing paid subscriber. So just go there now to bigtrends.com/festival. When you go there, you'll see this order page is really simple, right? There's a couple ways you can get started. I like the PayPal route. I don't have to type in so much. Either way, what you have to do is you'll review our terms of service, how we've done business now in our 27th year serving our Big Trends community. Once you've agreed to that, then you can either fill out all that information on that page, which if you do that, make sure you get your email in correctly over here on the left. That's the most critical field, in addition to, of course, getting your credit card information in if you want to put it in on that page. Or if you just want to save a lot of typing, click through on the orange PayPal button, and that will allow you to click through securely to your PayPal, choose your money source. A few clicks later, you've locked in the next 90 days for 177. There's no future auto bill, no auto renew, so you don't have to worry about that. Just try it for 90 days for 177 bucks. I think you'll find that, hey, one trade alone could pay for this many times over. If you've got any questions, call us at our 800 Big Trends number there. It's 800-244-8736. You can also email my customer service team via clientcare@bigtrends.com. So it's all right there for you. So remember, this is such a value that I'm only going to make it available for the first 25 traders only. I'm out of time. I want to keep Dave on time. So basically, there's a lot of great fellow traders and speakers to come. So stick with them throughout the day for the festival pack lineup that Dave always puts together. And keep trading well and staying well. And let us know if you have any questions. We're here to help. Go to bigtrends.com/festival, and that discount's already yours for more than $700 off, just 177 bucks. Back to you, Dave. Thanks so much.